But Gopal Srinivasan joins us. Let's take a conversation forward with him, Chairman and Managing Director with TVS Capital Funds. Gopal, good morning. Thank you for joining us. Exactly a year ago, 2023 December, everyone had almost written an obituary for consumer tech, fintech, startups. The words which were used like it would be a long, snowy winter. Now the tide has changed again. Now we are talking about excitement, IPO activity, NP deals starting again. So was same time last year more like ugly truth, or this is the reality?
Nikunj, good morning. Basically, I just wanted to say I was quite puzzled that in the middle of a hectic show, which is talking about instant movements of stocks up and down and so forth, there is somebody who is from an industry where 5 to 10 years is normal life cycle and not 1 year. So it was good to know that you wanted to talk about private equity in this matter. Actually, if you think about it, Nikunj, basically the entire funding cycle of say 2018, 2019, 2020 and so forth, roughly India was doing roughly about 30-35 billion dollars a year. So let's say we're now back to that number, leaving aside the exuberance of those 2 years where the private equity funding went a little bit higher to 65 and 48 billion in 21 and 22. I think we must think of this as a very, very careful asset class where entry pricing is going to be very, very important as much as opportunities. Today, I think we're at a time where the opportunities are good and the pricing is good. If you look at the exact breakdown, you will actually see that buyout activity in 2023 has been quite good. It is venture and growth. And should you also not think about one simple idea that this kind of cleansing which takes place because there was hyperactivity in 21 and 22, the pricings was little bit, shall we say, exuberant or shall we say irrational. And the recovery from that is also part of the cycle, is it not? So we should actually celebrate this reduction. We should celebrate the fact that the cleansing has taken place. And now the deal activity, I can tell you from our own pipeline activity we see, I think you will see 24 to be a decent year.
Gopal, so 2023 we saw markdowns for all the P investors, individual audit firms. There was like a race to the bottom that where the markdown will be the highest. Now that interest rates have peaked out globally and flows in a sense are getting better, most of the startups have realized that they're conscious of not growth but growth with profitability. Do you think we are in for a year of markups? Excuse me.
I think markups have already started. Basically, I think even the markdowns were very muted in some sense, right? People were trying to not try to do the markdown in most cases. There were some very high headline cases, which you would have all of us have read about. But really, in some sense, it was more a flattish market rather than a markdown market, I would say, at by and large. Now the market is back, and I think you will see that essentially fair pricing will prevail for some time. I wouldn't say exuberant pricing. Your point on interest rate, can I just take a minute on that? See, if you look at India, out of the 30 billion, let us assume that something like 10 billion is from India, right? From Indian AIFs. The foreign money had a lot of leverage at the fund level, in particularly in certain funds such as, or the big names, where they would actually take leverage against the investments they made. That was very strongly stimulated, let us say, by the availability of 0 to 1% money. That money is dried up. So I think it will take a long time before you see the interest rate affect private equity venture capital activity, because the manner in which it affected us was very simple. It was the big bulge bracket growth VC funds leveraging the investments they had made, taking mark to market as an advantage and borrowing more at 1% or 2%. That I think will take a long time to recover, right? Because 4-5% interest rates at a base level in America would not be necessarily as attractive.
The other thing is, morning firstly, what we had in 21 was a very different segment of players coming into the market. What we're seeing now is that the economy and the market has opened up. I mean, you've got defense, you've got renewable energy, you've got agri-tech. Tell me, what are the new verticals that are coming to the market to raise capital?
Hi, Aisha. So basically, I think if you look at the 2023 breakdown, you will see two interesting pieces of data. First is you will see buyout activity actually has been quite good at about 8.5 billion or so. I'm just looking at my notes. The other thing you will see is energy and manufacturing are the two sectors that are beginning to draw a lot more attention. So you will continue to see, in addition to the overall growth, which is infrastructure funding, which we don't directly keep looking at, that energy and manufacturing will be the growth areas in addition to our usual IT, ITES, fintech and healthcare, which is, let us say, the bread and butter of this business, right? This really bread and butter is these three areas. You will actually see more activity. And I think 2023 has started seeing good activity in both energy and manufacturing. So I think that's great news. And if India is going to have 20-30 trillion deficit in terms of just green energy financing in the next 20 years or 10 years or so, definitely you're going to see this as a very big opportunity for us. So hopefully, what we're seeing in both the global investment meet in Tamil Nadu, now with Vibrant Gujarat, look at the kind of announcements, 2 billion, 4 billion in large manufacturing, that creates a lot of secondary demand through tier 2 suppliers, who actually is where probably you'll see more of the private equity funding taking place.
Thanks so much for joining in, Gopal. Let's also understand from your perspective, in the current scenario, given what we've been through after we saw that flurry of money being pumped in the year 2021, and then there was sort of a reality check coming in the past year. What is looking good in terms of investment themes down the line? The sectors like, say, B2B, agri-tech, defense, etc. Are you looking at any of these sectors closely?
To me, I think the sectors that look really super good are the safe ones, which is fundamentally, if you look at financial services, right, there is this digital public infrastructure driven opportunities. I don't think we have really seen more than just the beginning of that right now. Whether it is account aggregator system, we saw it from UPI. Now RBI is talking about the frictionless credit platform, which gives land records data. The insurance regulator is talking about Bima Sugam. The health regulator is talking about a national health stack. There's agricultural stack that is being spoken about. So I think the entire movement around public infrastructure is going to create a tremendous amount of private innovation. Let's not forget, it is companies like PhonePe, Paytm and others who actually created the activity around the UPI infrastructure to actually scale it to this level. So that is one area which is going to be in the FS area, which is maybe attracts 20-25% of the investment. The other is obviously tech, right? I think AI is changing the world is a thing we hear about 10,000 times a day. And fundamentally, you're going to see a lot of companies either providing AI-led IT services or basically redoing their entire SaaS product or the application software product to become AI-led. So I think tech and financial services will be big areas. Health, always eternally a good area for India in terms of quantity. As far as, say, frontier tech is concerned, space or defense, I'm not sure the ticket sizes will be as big, but maybe they are areas for the future to think about. I think energy and manufacturing is the other big area. In terms of stages, I think in the longer term, India is going to emerge as a very, very strong buyout market. Because as this, just like, we had such a large $120 billion worth of funding in VCP in 21 and 22, and suddenly it has come down to, half that number or so. 120 was for 2 years, so 60 billion a year, it became 30 billion a year. The correction cycle, as businesses grow, you will find founders, promoters wanting to sell off parts of their business, all of their business. I think if I had a 10-year vision of India, it will be a lot of activity, a buyout stage as well. We should not forget buyout as an important stage to come to India. And look at the kind of Indian funds that are coming up, right? Just in our own growth segment, there are about 7-8 funds that are coming, which have become maybe in the second or third fund. You know the standard names. So there are about, I think, 7 to 8 such funds in the growth area. There are about 15 or so in the VC area, Indian funds. So I think you'll start seeing buyout also come as an important area in the future. In addition to tech, financial services, healthcare, which is what I call the bread and butter areas. And then, of course, emergence of energy and manufacturing, I think, as 2 big growth areas. And frontier tech, like space, some activity, but perhaps the volume of the value of investments maybe where to look forward in the next 5 years from now.
Just for a moment, I would like you to stay on with us. We just want to take a quick deviation, and we had some footage as well that was coming in on your screen that was taking place just right outside in our office. That's Sundaraman Ramamurthy, the MD and the CEO of BSE, that is our guest editor for the day. And there you can see that's in our conference room. We'll be getting his view on what is driving the meteoric rise in equity investments. You remember, BSE is the oldest and the only listed stock exchange in the country. So it would be interesting to get his perspective on the benefits of rising financial literacy, what's in store for the company, as well as equity investment and how the base can grow. So do stay tuned for that. That's coming right up. But just to get right back to our discussion, Gopal, and wanted to get in your sense as well on what you believe could be the trajectory going ahead when it comes to the budget for the startup space. Do you think that a lot is riding high in terms of the wish list? How have you read into some of the big, bold steps as well that have already been taken by the government when it comes to startups?
This year, I don't expect anything because this is an interim budget, right? So we have huge expectations from the June 24 budget. When that comes through, a lot of activities are pending. If I take the first 1 or 2, it would be essentially the expectation that this incentive for long-term capital gain to public markets compared to private markets have really grown. Today, the global private market pool is about $10 trillion nearly, I expect, when the result comes out from the McKinsey annual report. We really need to make sure that there are no disincentives for private investing by making our capital gains tax higher than public markets, right? This has been pending for about 4 or 5 years. There are a bunch of other things we're hoping to see. The finance minister has been quite a visionary when it comes to startups and the venture capital, private equity industry, as well as other areas. So we're expecting that certain things such as the tax structures will improve. But if I could say so, our biggest ally for the growth of our industry has been the regulator. And equally, I would say the biggest friction for our growth is also, in some sense, regulation, not the regulator. And we need a more progressive regulation where the regulator is willing to take a little bit more risk, I would say. And I've used the word regulatory risk to develop the industry. That is an area, there are a series of consultations. The regulator is super consultative, I would say. And we really need to see those areas probably improve in addition to budgets. Budgets are one part of it. Regulation is another part of it, especially for domestic capital. In this regard, IFSC has been an absolute trailblazer. I think they've come up with so many good policies in terms of making sure that AIFs get their foreign pools into IFSC. You might have seen direct listing as IFSC recently. You would have seen family offices trying to set up in IFSC for overseas direct investment. So I think both regulator as well as budgets need to help us. And if I could say that perhaps both are equally important in our future. There is an important report you might have read called the Damodaran Committee report a year and a half ago, which thanks to FM's and vision that was put into place. So all the recommendations are there, and we are hoping to see that actually come into light perhaps in the June budget.
Right. I have to ask about what do you think are the core principles now which are guiding larger startups which are, sort of in queue to hit the markets and are IPO ready already maybe in the next 2 to 3 years. And it's a large list now, right? You've got Ola, you've got First Cry, you've got Swiggy, all in the pipeline. Clearly it seems that, it can't be a combo of what we saw in 2021. It can't be absurd valuations and no profits. So profits is something that they have to be, ready with. But what else do you think they will correct this time after learnings from 2021?
I think what you will correct mainly is that this exuberance and belief that somehow investing in these companies is going to create dramatic outcomes, right, will completely, I hope, be more muted. And I think the stock market should hopefully see that 6 months, 1 year after the IPO, the stock is at least holding its own rather than declining. That is something that we saw in the last round of startup listing. And this is part of the normal maturity of the industry. I'm also hoping that basically the idea that we can list in the IFSC will be another new feature of listing, that a lot of the companies, especially in the tech area, which moved their cap tables to Singapore, to Dubai, or to Delaware, would actually be able to relocate to the IFSC, and the government will come with some innovative policies, making sure that Indian companies with cap tables in IFSC can get listed in IFSC, and perhaps even, who knows, with some form of domestic participation. I think that would be interesting to see the smaller startups. When I say smaller, I mean the valuation range of, say, 2 to 5,000 crores market cap come into the market. There's a lot of supply in that area. And, without exit, there is no entry, right? Without death, there is no birth. In some sense, without exit also, there is no entry. Because as we get exit liquidity, more money comes into the sector. So I'm hoping to see smaller and mid-size startups. And I'm hoping to see overseas listing in IFSC, particularly of Indian startups, as a way to get more and more activity in the system.
That you've spoken about promising sectors, etc. What is it in specific that you're adding to your portfolio?
We are a very boring investor. Private equity investors should always be boring. And fundamentally, that's very, very important. I think the theme I'm seeing more and more come through is, and we're going to talk about education pretty soon, is that depth is becoming more and more important. The idea of a sector agnostic fund was where the sector was born, because the markets were shallow. Now I think you're finding funds that like ours, which we say alpha from depth, right? Which is fundamentally you understand some sectors super, super well, and therefore you're able to get better companies and able to make better decisions and also add more value. I think that is something that's coming up. So we are absolutely bullish on financial services. We're also opening in our next fourth fund, which we're currently raising a new product, which is a tech portfolio, enterprise tech portfolio. So those are the two areas we are super bullish. Let's not forget, 16% of the global tech talent, as per some estimates, resides in India. And I suspect that will become even higher. We have a disproportionate amount of tech people in the country, right? And in financial services, we have the demographic in our favor. We are adding, another 30, 40, 50 million families into the consuming class very rapidly. So these are the two areas of our interest.
Okay, good to have you on board. Thanks so much for just giving us a clearer picture as to what the overall spectrum looks like when it comes to the startup world as well as emerging themes.